Good evening, ladies and gentlemen. My name is Jagdeep Aluwalia. I am the founding secretary of the Indo-American Chamber of Commerce of Greater Houston. And we are a 21-year-old organization that was established to help small, medium, and large businesses grow and add to the local economy. Though initially we focused on business with India, but today most of our work is in empowering our local community. We have several initiatives, and today's webinar is being launched with the help of Dilbagh Singh and the next generation. Anish Nagar is the chair of the Next Generation Committee of the ISCCGH, and Dilbagh is one of the co-chairs. And today's speaker, Anasuya Kabad, is on their board. So we are very privileged to have this group working very closely with us, because the Next Generation Initiative, the Next Gen Initiative, was launched with the help of our then board member, Narayan Bhargava, who brought on board this team of very intelligent and very successful young men and women to lead our engagement with the next generation. It is an extension of the chamber. It is our way of connecting with the next generation and helping them understand our legacy and understanding from them how to do business in this new world. Today's webinar will be recorded and forwarded to all participants, and we will load it to the chamber website. So the two people who are responsible for this are Dilbagh, who is the co-chair of Next Gen Exchange and co-founder and director of customer success of NG Organize, where he provides organizations with tools and support needed to achieve their goals. The chair of the Next Gen Committee is Anish Nagar, who is the CEO and founder of NG Organize, a software startup that helps organizations of all sizes and types track, measure, and report their social impact. I will now be handing the program over to the Next Gen Committee to move forward. I do want to thank Anusia for making the time to share her knowledge and expertise with all of you. For the benefit of the participants, if you go to the Q&A box, you can type in any questions, and the Next Gen Committee will respond to your questions. And I will come back at the end to just wrap up the program and say thank you. With that, I'm handing it over to Dilbagh and Anish of the Next Gen Committee.
Thank you, Jagdeep ji. Hey, everyone. My name is Singh. Thank you so much for the time. We're going to be spending our time today discussing the financial uncertainties we're all dealing with and how we should go about dealing with them. So today we have Anasuya with us. Anasuya is a certified financial planner, JK Wealth Advisor Incorporated. She is passionate about helping young families and business owners build a strong foundation. The goal is to simplify complex financial matters and help clients feel empowered about their wealth. Outside of JK Wealth Advisors, Anasuya is also a board member of Next Gen Exchange, as you heard, as well as a board member of Daya Houston, which is a nonprofit that helps South Asian survivors of interpersonal violence. Anasuya, if you'd like to get started.
Great. Well, thank you all for being here. As Dilbagh mentioned, I am a certified financial planner, and so my job is to really help people make smart decisions about their money. And, my job revolves a lot around planning for how we can structure your finances to help you achieve your long-term goals. And there's really nothing like a pandemic to make you pause and think about how your plans are going and what needs to be adjusted. And I find it very similar to a pilot flying a plane, because right now, when a pilot flies a plane and experiences turbulence, you don't see them just winging it and hoping for the best. Instead, they have plans and protocols and principles in place to rely on, and that's what helps them get back on track. And so in a similar fashion, we as young professionals, we are all pilots of our own financial journeys, and we're hitting some turbulence right now, and that's when we need to start thinking about what we need to do to stay on the right course. So next slide, please. Next slide. So I have to make a few disclaimers, of course. What we're going to talk about is just general concepts on planning and investing. And if you have specific questions or specific needs, please make sure you speak to a professional that can really help address your concerns, your specific concerns. The other thing to mention, of course, is that we're going to talk about investing, and investing does involve a certain level of risk. And so, it's important to just share these disclaimers up front. But as Jagdeep ji mentioned, we do have the chat function. So if you have questions, we'll have some time towards the end to talk about it. Next slide, please. So with that said, there is a lot of uncertainty right now with this pandemic. And I think, we are really seeing and feeling the impact of the virus. And, we see businesses close. We saw the rodeo close. We're all working from home. Unemployment is going up. And there are so many things right now that are really out of our control. But what I would encourage right now is instead prioritizing what is important to you and what can you control. And so that's what we're going to think about today right now is when it comes to your personal finance and investing, what are the things you can control and what are the things we can focus on right now? So what we're going to talk about, I'll spend a little bit of time thinking about cash flow planning, how we're managing our finances, and then I'll spend a little bit of time talking about it from the investment perspective as well. So next slide, please. So when things get crazy, we just have to get back to basics. Now is really not the time to try any complex strategies, go, off the rails here. We really need to focus on the basics. And, I work with people that are 30 years old all the way to 87 years old. And this simple cash flow equation that we all know will be the basis for the rest of our lives. But I bring it up because we need to think about, in terms of our income, our expenses, and our savings, what are the levers that we can really control during this time? And so I'll bring up a few suggestions in each of these areas on things to think about. So let's go ahead and go to the next slide. So when it comes to our income, unfortunately, there isn't much we can control. I'm sure many people have seen their hours reduced, maybe their revenue has gone down, maybe the raises or the bonuses that they were expecting are not going to happen this year. And then unfortunately, we also see the extreme where people are being furloughed or laid off. And so because of the CARES Act, which was, this $2 trillion package that was passed by Congress in early April, there are some government benefits that are available, and I want to bring it to your attention because it is meant to help people get through this time, and so just be aware of it. The first is the stimulus check that is available for adults, and if they're married and have children, their children too. So you're able to receive $1,200 per adult, and then plus $500 per child that's under 16 within the family. And to qualify for the full amount, it's based off of your income. And so if your income is below $75,000 for single filers or below $150,000 for if you're married filing jointly, then you would qualify for that full amount. The amount begins to decrease as you go over those limits. It decreases by $5 for each $100 that you earn over those limits. And so it really starts to phase out for people. If you're single, it phases out at $99,000, and if you're married filing jointly, it phases out at $198,000. The thing to be aware of with this is that if you qualify, you automatically get the well, not automatically, but you get the funds. You don't have to actually do anything to get the funds because it's based off of the information you provided in your tax returns. And just to note, the income amounts that they give for you personally is based off of what you filed in either your 2019 return, assuming you've already filed it, or if you have not filed your 2019 return, it'll be based off of your 2018 tax return, whichever one is filed. But that said, you don't actually have to do anything if you qualify for it, but if things have changed in terms of your bank accounts or how you would like to receive that those funds, then I've put the website here, the IRS website, to go to update that information and just get more information about those payments as well. The other thing to be aware of is, unfortunately, if you do get laid off or get furloughed, you're not able to work. The CARES Act has really expanded the definition of who can apply and receive unemployment benefits. And so it might be worth it to look into, for example, it includes people that are self-employed or part-time workers. So the benefits might be available to you as well. The other thing to be aware of is they've, through the CARES Act, they've given an additional $600 per week for eligible workers on top of the state benefit, and that's up till July 31st. I would say if you are without a job right now, apply early for unemployment, apply through the website. The Texas Workforce Commission is open on the weekends these days, and it's very difficult to get a hold of a person just given how many people are going through this right now. So just apply early. It will take time to start receiving benefits. Next slide, please. So when it comes to the expenses side, this is where you have to really review your budget and start planning for contingencies. And like I said, it doesn't matter if you are in your 20s or in your 80s, your budget will always be your best friend. And so this is really a very important time to review your spending, how you do things. So I've kind of broken it up into 3 areas to think about. The first is your priorities. What do you absolutely need right now? And where can you cut expenses? Take a look at your spending. And in some ways, I find the past couple of months, we've been forced not to spend as much because we couldn't go to restaurants and things like that. But, take a look at it again and think about where do I want to focus? And, if my income is limited, what do I need to focus on for the time being, and maybe cut some other things out for the time being. The second thing to remember is that you might need to be proactive if you're not able to make payments. You need to be proactive about talking to your lenders or, utility companies, things like that, about getting flexibility on making payments. Because right now, mortgage companies, credit card companies, utility companies, so on and so forth, they're all offering options in terms of deferring payments or maybe interest only or so on and so forth. But you need to be proactive about finding out about that. Just don't wait until you've missed the payment to start talking to the people who need to be talked to. So be proactive. And, even if you're not in a situation where you're, laid off or something, just be aware of it and think about your specific providers, whether they offer some flexibility, just so you're aware. And the third thing to be aware of too, I would say, is just, avoid taking on new or more debt. Right now, I'm sure if you're on Instagram or social media, you see that the ads for retail therapy are going crazy. Everything is 75% off, and it's very tempting to maybe want to spend more at this time to make ourselves feel better. But this is really a time where we have to just be careful and be cautious. And the last thing I would say is just remember that this is temporary. If you are, you know, it really stinks to have to kind of tighten the belt right now, but just remember, hopefully this time will pass in due time and we can get back to normal. But it's always helpful to have this kind of emergency contingency planning in place. Next slide, please. And then last but not least, we need to think about our savings. And so this is, you know, nobody really predicted that this pandemic would reach this extent and hit us hard. But if you have the ability to save, or you're able to cut your expenses and save more, this is the time to really be having a little bit more of a cushion. And it starts with your emergency fund. So your emergency fund is how much do you have in cash in your bank accounts right now. I'm not talking about your retirement accounts or investment accounts, things like that. Really, how much do you have in cash? So the question is, if you were to get laid off, how long could you live on your emergency fund? And that's exactly why it's there for this time. So you want to try to cushion your emergency fund and have, I would say now, probably more like 6 months of living expenses in cash. And, you know, the thing I would say to think about too is if you're in more specialized jobs where it takes more time to get hired, you might want to cushion that even more. So really making sure you have a strong foundation in your emergency fund will be very important. The second thing to remember is now is a good time to start building habits, good habits on saving. You know, think about your 401k. The money that you don't see in your bank account is the money that you don't spend. And somehow, you know, forcing us to move it from one account to the other account that's just a little bit harder to get to creates the ability for us to save and you know, put money aside. So really think about how you are saving and set up that autopilot. It's very easy for us to set subscription type services like Netflix where it automatically pays and we don't have to worry about it. So let's set up the save system in terms of our saving too. And then the third point I would just encourage you to remember is that your retirement accounts are really, you know, for your retirement. They're for your future self and your future well-being. And so when times get desperate, really avoid taking money out of your retirement account. Because of the CARES Act and the stimulus package, all this that was passed, there are a lot of leeway that has been given, a lot of flexibility that has been given in terms of taking money out of your retirement accounts or taking loans off of your 401ks. They are now allowing a greater amount for loans off of your 401k. You don't have to pay penalties if you take money out of your IRAs. That said, you do still have to pay ordinary income taxes if you withdraw funds from your IRA account. You don't have the penalties, but you still have to pay the taxes. And so I bring that up because they have made it a little bit more easier to have access to those funds. But as much as possible, you know, if you can keep it as a last resort and not touch those funds, you know, you're protecting your future self. That's what I would say. So we've gone over just the different facets of your cash flow, your income, your expenses, and your savings, and what levers of control we might have available to us during this time. So, you know, now is, you know, when we can't go out and have fun as much as we used to, there's no better time to kind of sit down and get organized with this. Sometimes some of us may be forced to do it right now, but if you're not forced, if you're in the lucky position of not being forced to do it, you know, still use this as an opportunity to build some good habits. So that's on the cash flow. So now, next slide, please. So now let's think about getting back to basics with investing. And what are some things that we can control with investing? Now, when I think about young professionals and where we're at, maybe how old we are, this pandemic, this downturn is probably our first really experience in being invested in the market and experiencing a downturn. The last time this happened was 12 years ago with 2008 and the Great Recession. Some of y'all may have been too young, not, maybe you were just starting off in a first job, didn't have a lot of money to really participate in the market. And so this is really our first time going through this downturn. And I would say that, for a lot of people, I've gotten this feedback before. This is really different, right? This pandemic is very different from recessions in the past. And to that, I would respond, good, because it always needs to be different. You wouldn't want the same factors that caused a recession in the past to cause a recession again. So of course, recessions are always going to be different. But that said, the investment principles that we use remain the same, and they still are going to be our guiding principles as we get through this time. So I want us to keep that in mind. That's what I'm going to share, a couple of principles that I feel are really important as we go through this time of uncertainty. And, we see that reflected in the markets and how volatile the markets are by the different headlines. So next slide, please. Okay. So I've gotten a couple of different questions in so many different ways. How should I invest? Should I get out of stocks right now? Is now a bad time to invest? Is now a good time to invest? What are the opportunities available to us? I've gotten all sorts of questions like this, but at the end of the day, my response will always be, it depends, and it depends on you and your goals. And so what I think right now is, this is the basic tenet of investing, is thinking about what your goals are. And I'll get into a little bit more detail about it right now. But what I find is there are these investment principles that we have in place that help guide us. But at the end of the day, our emotions, people end up doing things that they think are perfectly rational. They think it's perfectly rational, but it actually ends up being detrimental to their long-term goals and what they wanted to do. So the rest of this presentation will kind of be about cautioning against those kinds of things. So before we move forward, I just wanted to put a question out there. When is the worst time to get off a roller coaster? Just think about that for a second. When is the worst time to get off a roller coaster? Next slide, please. So the worst time to get off a roller coaster is when it is in motion. Makes sense, right? That's the worst time to get off. And whether we like it or not, we are all, many of us, I would say, are all on the roller coaster of investing through our 401ks, our retirement plans. Maybe we have separate investment accounts available to us. And, when it comes to this kind of business cycle that we're going through, the markets are always, in different parts of the business cycle. And, we have to think about our strategies in a way that will, that'll survive the different market cycle, parts of the cycle that we're in. To that point, though, I would say, we cannot control what the markets will do. And we cannot control what headlines are going to come into the news tomorrow or, the next day. And we can't control how people feel about the economy and stuff like that. We don't really have that level of control, and we don't have a crystal ball either to predict what's going to happen. So I bring that up because, next slide, please. I bring that up because it's really important for us to recognize the emotions that we feel in different parts of the business cycle and different ways that the markets go up and down and how we feel. So I think this is just a fantastic visual of that. And so these are the different emotions that people feel along the cycle when the markets are going up and then when the markets are going down. So let's take a quick look. So when markets are going up, people are feeling optimistic. This is looking good. And then they get excited. And then they're thrilled because they're making money and they're doing really good. And, you think about when you're at the top of the top, you're feeling euphoric. You're feeling really excited. So for a lot of people, think about just the past couple of years. In 2017, even just last year, we didn't really have to do anything. We could have just put the money in the market and, whether that, the S&P or whatever, and we would have made money in those years. Nobody really knows when markets are going down until it actually does go down. It's very hard to tell unless, hindsight is 20/20. And so when markets start going down, when the markets are up, people are thinking the market is hot. I will miss out if I don't buy more equities. And so what we do see investors do is they start to get more aggressive and not realize the risk that they're taking on those portfolios. And then, of course, like we saw in February, March, markets start to go down. Unfortunately for us, it wasn't the slow descent. It was like hitting a wall, a car hitting a tree, and it went, the fastest it's ever actually gone down. But then we think about the emotions that we feel when markets go down. We're anxious, we become desperate, we become really panicked, and then we're really depressed. And at that time, people are thinking, whoa, this is terrible. I don't know when we're gonna get out of this, and I can't see it go down any further, And so you think about maybe when you saw your 401k statement in March and just kind of how red it was looking at that time. And for some people, they think, gosh, this is never gonna end. I don't know when this will end, and I just need to get out. And so it's in those moments of depression, really, when the markets are down the most, that there's actually, the opportunity to, that's when there is actually opportunity, because we know eventually markets will go up, and that's when we start to feel hope and relief and then optimism, and we start that cycle again. So I bring this visual up because, the basic principle of investing is to buy low and sell high. But many people go through this emotional roller coaster and end up actually doing the exact opposite. They buy high and then sell when the markets go down because they can't take it. So I bring this up to make sure that you're aware of the emotional roller coaster, how you might feel. And now we need to think about, okay, let's take out the emotion from the investment process. So next slide, please. So if we're not going to be basing it off of emotion, then, what is our investment strategy based on? And the investment strategies, and I'm thinking more for long-term investors here. I'm not thinking about the day traders. That's a different type of, methodology. But for long-term investors, having an investment strategy driven by your long-term goals and not by the daily market volatility. And so, the perfect example that I think about is, remember when we used to have traffic like 2 months ago, and we had traffic on 59, and we really hated that traffic, right? So we'd be in one lane and we turn to the side and we'd notice that the next lane is going, and they're happy to be driving. And so what do? You move over to the side lane, and then right when you move over, what happens? It stops. And then you look to the next side and you see that lane going. So if you had just stayed in your lane, you would have been fine. And so this is what I mean by daily market volatility, daily noise. Things are always changing. And so instead of changing and doing things and it ends up not getting you to where you want to go, we need to have an investment strategy that's really driven by you and what you want to achieve. So I've put some factors down on the slide of what we look at when it comes to building an investment strategy. So, think about your time horizon. When do you actually need these funds? Your comfort level with risk. Are you comfortable seeing portfolios drop, even though in the long term it will recover? Are you still comfortable with that drop? Some people can't sleep well with that drop. So those are just a few examples of it. Next slide, please. And so based off of, that kind of information about you and your goals and what you're looking to do, then, and based off of the risk you're comfortable taking, that's how you can determine what kind of allocation you want for your investments. And that's how you allocate, you decide how much you want to allocate between stocks and bonds. And so this is just the basic tenet. And because what happens is a lot of people, when markets go down, they think they need to do something about it. There's just this innate sense to want to do something, to feel like you've done something and you feel like you have control over it. But remember, if you take into consideration what your goals are and you created an investment strategy that's based off the risk you're willing to take, you understand the risk with the investments, then for most people, they're able to just kind of sit tight and let it ride, as opposed to, like I said, the lane switching where they're going back and forth, but then they're actually not really getting anywhere. And so, when my favorite phrase is, don't sacrifice your long-term goals for short-term volatility. Keep that in mind. Keep that in mind, especially during these times where we're really, we've kind of hit this first bottom. It's to be determined whether it'll go down further, but, we're all waiting for this recovery, whenever that may come. We just have to be patient. So next slide, please. The other thing that I find really interesting is people are trying to time the market. So for some people, there is we find that many investors are trying to get in and out of the market. And the reason why is because when they see that markets are going down, they want to try to cut their losses. And then they're like, I'll just wait until the markets start to recover, and then I'll get back into it. And what we find that it's really more about how much time you're in the market as opposed to timing the market. And so this visual to me is just very eye-opening, and I'll walk you through it. So basically, let's pretend you have invested $100,000 in the S&P 500, and you invested that from 1999 to 2018. So you've experienced quite a lot in those 20 years. You've experienced the tech bubble, you've experienced 9/11, you've experienced the Great Recession. And so it's quite a comprehensive amount of time right there. Let's say you had invested that $100,000 and you just stuck it in there and you let it ride the roller coaster. After those 20 years, if you had stayed invested, you would have gotten potentially $298,000. Not bad. Now let's think about, what if you had missed the top 5 best performing days in the market? So think about how many days are actually in 20 years. There's a lot of days, right? I haven't done the math, but there's a lot of days, and you've only missed the 5 best days. What is phenomenal to me is that by just missing the 5 best days, your final outcome could be $197,000. That's $100,000 that you could have missed out just by missing the top 5 days. And then we show, what if you had missed the top 15, the best performing, the best 15 top performing days? What would your value be at? $117,000. And then what if you had missed the top 25 days? Then you'd actually have lost money over the 20 years. That's pretty crazy to me. And the reason why that is, it's like if you had just taken the money out on those days. It's hard to know when is going to be the best performing day until the next day, right? You don't really know on the day of. But what the research has shown, and this is from BlackRock, what the research has shown is that the best performing days came within 1 month of the worst performing days. And that's not, all the time, but for a significant amount of the time, the 25 days, most of them came within a month of the worst performing days. But remember, go back to that emotional roller coaster. When you think about it, it takes a lot of time to get over the depression of your seeing your values drop. And so for many people, they forget that, you know, the markets will recover, and they go back into the market too late and miss the full rebound. And so I say it time and time and again. I say it time and time and again. You know, it's not about timing the market and getting in and getting out at the right time. It's just staying invested for the long haul and letting things ride. And because your portfolios are based off of your investment goals and not just based off of the daily volatility. And so it's really difficult to do, and it's not fun to do, but I really think it's important. And you know, we all want, you know, the money that we are working for, we worked hard for, and we want it to work for us eventually, you know. And so investing can be a great tool to helping us achieve those goals. But you know, we have to keep these principles in mind. And so next slide, please. So I'll wrap up with that. You know, we talked about cash flow and what are some things to think about for your cash flow. And then we also talked about investing and remembering that, you know, the worst time to get off a roller coaster is when it's in motion. And so instead of, you know, having our investments based off of what's going on in the market, really basing it off of our investment goals and what's important to you, where do you want to go? So those are the things you can control. The market, the noise, the volatility, the uncertainty, that stuff we can't control. And unfortunately, you know, we never will be able to. But there are certain things that we can do right now. And I just want to wish you all the best. And I know this is a tough time for many people in so many different ways, but there are so many resources out there and information out there to help us in different ways get through this time. And so, you know, like I think that the Chamber is putting on so many great events. NexGen is planning to put on more great events, and we hope it can continue to be a resource for you. So with that, I'll turn it over to Dilbag or Jagdeep Ji.
So Dilbag, are you able to log on? Because Dilbag texted to say that he was having some issues with his audio.
Oh, yes.
So
actually, yeah, I can moderate the Q&A right now, actually. Right now, it looks like we just have one question.
Yes.
And it's the question is, with the simplified rules for taking money out of retirement funds due to the pandemic, please explain. So basically right now, it's in your retirement accounts. There are different types of retirement accounts out there. You know, you have your 401k, there are IRAs. Right now with the 401ks, typically the max amount you can take out is $50,000. They've increased that amount to $100,000, and that's what I mean by taking out. You can take a loan off of your 401k and pay back that loan over time. So they've increased the amount that you're able to take a loan off of your 401k to $100,000. When it comes to IRA accounts, you are able to take money out of your IRA account, and you would have to pay the taxes on that on the funds you withdraw, but you no longer have to pay the 10% penalty. And in fact, they have the government has gone so far as to say, we're even giving you some time to pay the taxes. I believe they said you could spread it out over 3 years even. So like I said, you know, my hope is that this is really truly a last resort, taking funds out of the retirement accounts, because, you know, it is supposed to be there for your retirement and your long-term well-being. But I do understand that sometimes push comes to shove, and you know, when you need those funds, you gotta evaluate what options are available to you. So that's the one question I see right now.
Hey, Anthony, I wasn't able to type in a question. This is Thomas, but is there any specific industries that you would say to avoid, or is it, you would recommend investing in?
Oh, okay. So the question is, are there specific industries that we would avoid investing in right now?
Yeah.
That's a good question. I mean, I think it really depends on what you are looking to do. The way I would put it is the contrary, right? The things that people are avoiding right now are probably the things to invest in, because eventually it will recover and go back up and you're catching it at the low. But for a lot of people, don't have the patience to do that. And so I find that instead, you really want to continue maintaining a diversified portfolio of investments in different industries. Diversification is what is the name of the game in terms of long-term investing.
Okay.
Anusia, here's another question. Can you explain new RMD rules differing?
That's a good question. So this is for retirees. If you are, over, now they changed the rules. So now it's 72 and a half. If you're over 72 and a half, you're required to take distributions from your retirement account. And there's a particular table that tells you how much you're required to take every year. And the reason why is because, on your IRA account, it's specifically IRAs and 401ks if you're no longer working for that company. It's specifically for IRAs and 401ks. And the reason why is because you've never paid taxes on that money before. And so the government wants you to pay taxes on it. And so that's why they require you to start taking distributions at a certain age. Because right now what's happened to so many people is that the markets have gone down, the portfolios have gone down, their IRAs and their 401ks have gone down significantly. And so the government said, for this year, we're not requiring you to take distribution. We're not requiring you to take that required distribution this year. It's waived for this year. And so that's nice, because then you're not selling funds at a low point. We can wait till next year. Hopefully things will, start going back up. RMDs will resume in 2021. So that's what they mean by that. I assume that's what you mean when you say deferring. It's waived for this year because of the CARES Act and the legislation that was passed earlier this year.
Thank you very much for answering that question. In fact, thank you very much for such a powerful presentation. Very informative, very useful. It will be recorded. And I do want to advise all attendees that today's webinar is for information only. We suggest that the attendees consult a professional to answer your specific questions or to address your situation, because this webinar is for information only. And sometimes when you're listening to a webinar, you may misinterpret what the speaker is saying. So we would not like either the speaker or the chamber to be held responsible. While we are waiting for people to type in any further questions, I'm going to invite either Anish or Dilbag to talk about some of the upcoming nexgen events, because they have put together a very powerful package of events in a continuous series. And I don't know whether it's going to be Anish or Dilbag, but I'm handing over to the nexgen committee to talk about upcoming events.
Wonderful. And thank you again, Jagdeepji and
Bhavna,
the chamber for...
Would you like to stop screen sharing so Anish can come on full screen?
Thank you everyone again for attending our event tonight. Thank you, Jagdeepji and the chamber for not only supporting us through this new series we have, but just supporting nexgen Exchange and the young professionals here in Houston over the last few years. And thank you again, Anusia, for the fantastic presentation. I think, I know this video is recorded. I think Anusia's information might be in there. So if anyone does have questions offline, be sure to ping her about it. A little bit about some of the events we have coming up. We have 4 more events on the schedule. The plan is to do these events just about addressing practical tools during challenging times during COVID-19. And we'll be doing these every week, every 2 weeks. So the next one will be June 3rd at 6 p.m. Central. And the topic for the next session will be pandemic anxiety. The goal here is to address a lot of the mental health and anxiety around the situation we're in, not only for small business owners, but professionals across all industries. After that, we'll have a event over the job outlook and career forecasts, as well as one over startups and entrepreneurship. And we'll end our 5-seminar series in July with our Young Minds panel over talking about next steps for students, as well as young professionals. So with that being said, thank you again, everyone, for the time. It looks like we don't have any other questions. So Jagdeepji, unless there are any other last remarks, I think we can go ahead and conclude today's event.
Yeah, I do have a couple of comments to make. The first thing is, again, I want to thank Anusia for making herself available. Traditionally, at an event like this, we end the event by presenting our speaker with a small elephant. We will keep feeding the elephant till the pandemic is over and present it to her when the time comes. So we do have a small memento from the chamber to thank our speaker for making time to speak to us. We do appreciate what your family does, because both your parents are giving and caring members of our community. And we are proud that the next generation is as giving and caring as our generation. So we are proud to have the next generation involved. I'm very, very proud of the effort of the next gen, because the future of the community is in the hands of the next generation. And to have such a energetic young group of professionals and business owners engage with the chamber allows us to move things forward. I do invite all our attendees to visit the IACCGH website, iaccgh.com. It'll give you an idea of the history of the chamber. We are a 21-year-old organization. Our current chairman of our board and our president is Tarush Anand. He could not join us today. He's been giving us a lot of time, but he also is a partner in a very eminent law firm. And today, what people don't realize is we had 2 back-to-back events, and we are preparing for a 3rd event, which is with Senator John Cornyn and the United States Ambassador. And in the first section of that event, which is on May the 22nd at 3 o'clock, the first half hour, we will have representatives of Houston, Dallas, McAllen, and one more Texas city talking about how the pandemic has affected their business and how the efforts of the senator and the CARE Act and the PPP program are helping them in these trying times. The theme of the webinar on the 13th is strengthening Indo-US relations. And our chief guest is the US ambassador, along with Senator Cornyn. And in the second half of that session, we will have our advisors talking about what is happening in their sector and how they are working towards collaborating with India and building on the relationship. So it's going to be a very interesting and informative session. We are very proud of all the galaxy of superstars we have on it. Visit iaccgh.com for information. Everybody listening today and everybody listening to the recording is welcome. I also want to draw attention to the fact that if you go to the chamber website and click on the link news, you will be taken to another drop section where you can click on news again. And it will give you the flyers for our last 10 webinars since COVID-19 started. And if you click on each of those announcements, you will have a copy of the recording of the event. So for today's event, we will be loading Anusia's presentation, plus we will be loading the recording. And we are inviting and encouraging people to share those recordings and presentations with friends and family, because what is being brought up is very relevant. And the whole purpose of the chamber is to empower the community. So we are proud to be able to do that with the support of our board of directors and our members. And we are very proud of what the Next Generation Committee is doing. So with that, I think we have one more question, which you may want to answer. Ronak says, I'm sorry if this has already been spoken to as I had some technical difficulties, but could Anasia comment on what she thinks about effects on interest rates, as well as if someone is looking to purchase a home, when might be a good time to do that? I heard differing information on it. Some say Q4, some say wait next year. This would be as good as buying a lottery ticket and hoping to win. I don't think she wants to put herself in a spot, but I'll leave it to her to decide, because I would make a big disclaimer that I wouldn't give any guidance on that, but it's certainly up to you.
Yeah, I'm afraid I won't be able to speak on when a good time to purchase a home would be. But in terms of interest rates, I mean, it's as you all probably know, it's at an all-time low, and that's in efforts to help businesses and lending and things like that. But the other effect of it is it makes it very difficult for on yields for CDs, yields for bonds. All of them are at such all-time lows too. And you know, bonds are such an important part of portfolios. You know, they provide yield for retirees, and you know, they also are really important for diversification. But when there's such low interest rates and you're not getting enough yield, it's difficult to it makes it very difficult. So we'll just have to kind of hold tight for now and see how things ride out. I'm afraid I won't be able to answer the question about purchasing a home, but you know, those are just some of my thoughts on interest rates right now.
I also want to, we have another question pop up. Oh, it's just a thank you from Ronak, so it's not a question. I do want to mention and give a shout out to Ashok Garg. Ashok Garg was one of the reasons the Next Gen Committee came together with Narayan Bhargav, and he has played an active role in the creation of this committee. So I want to thank him for his support of this initiative. But again, the real thanks goes to the committee led by the three of you. You folks are doing a great job. The Chamber is proud of this initiative, as we are proud of our distinguished lecture series, as we are proud of our Women Mean Business series. So the Chamber is proud of all our initiatives. Sorry, I'm using my phone and somebody keeps trying to call me and hello. So with that, we are now at that point of the webinar where I'm going to invite Bhavna to pull up the slide for the next event, which is on May the 22nd. Bhavna, can you please display that slide? So this is the event we were talking about, strengthening US-India relations and challenging, Bhavna, and challenges of COVID-19 on Indo-American businesses in Texas. The two speakers are, the two chief guests are Senator John Cornyn and the Indian Ambassador to the USA, Taranjeet Singh Sandhu. In the first session, we have Bal Sareen from Houston, Arun Agarwal from Dallas, Dr. Jayarayan Naidu from Odessa, Texas, and Mr. Raju from McAllen, Texas. They will give the update I mentioned on what's happening, followed by a session where our advisors will be addressing the ambassador and giving him an update. It'll be a very interesting panel, and we hope all of you will sign in and join that. With that, I want to thank Bhavna for the great work she does in putting this event together. I hope that you will all follow the distancing rules and use masks and follow all precautions and stay safe, stay healthy. And let's hope we get back the prosperity we were so used to in the coming weeks or months. Looking forward to being able to host live events whenever the time is right. Till then, we will continue to host these events. Thank you very much. With that, today's event comes to a conclusion. Thank you very much.